This week, we're going to answer one of the common questions we get from clients, which is, what are some of the benefits of income investing if I don't need income today? So I often get asked, where do you come up with the topics for commentary after commentary after commentary? We've been at this for 8.5 years now, making up various commentaries. And the answer is client questions, prospective client questions, even advisor questions. They come up. We kind of use that age-old adage that teachers had when someone would raise their hand in the classroom, which is if one person's got this question, probably a lot of people do. One of the common questions that we get time and time again is, why should I consider being an income investor or having an income-oriented portfolio if I don't need that income today? It's a great question, and we're going to try to unpack why for some of you, again, income investing may make a lot of sense. Point number one, it's just a big part of one's return period. So I think one of the common misconceptions about being a quote-unquote income-oriented investor, or just having income be a meaningful part of one's portfolio, is that it somehow dampens returns or doesn't really count as a return. If you think about the analogy to a rental home, a lot of the money that one's going to make over time from owning a rental property or a piece of a commercial building is going to be rents. And in those cases, people correctly think of that rental income as a big part of their return. And so the same thing happens when we're talking about stocks, funds, ETFs, is that income is a big part of, and certainly a part of, total return, along with capital appreciation or depreciation over time. Some important historical data that we wanted to share with you to back this up. If you look back historically, just in the S&P 500, so before we even talk about bonds or credit or real estate, just even within stocks, which is what people often juxtapose against being an income-oriented investor, for those stocks paying a dividend, dividends for the S&P 500 have on average made up about 32% of the monthly return of the S&P 500. So again, a meaningful, almost a third of the return that the stock market has given people has been based off dividends. If you pull apart dividend growers or initiators versus non-dividend payers within the S&P 500, the numbers get even more stark. For dividend payers and growers or initiators, the average annual return has been 10.24% historically, versus non-payers where it's been just 3.95% total return over time. Furthermore, the dividend payers versus the non-dividend payers have had 28% less volatility. So if you think about, again, that holy grail that investors are trying to get, which is how can I maximize returns at the same time I dampen volatility, dividends, income in general have been a big part of that. Second is it's a great saving investment vehicle. One of the things we go through with clients who've chosen to embrace this approach, again, is how much money they're de facto saving every year. If you take the hypothetical $2 million account with 5% type cash flow, which is pretty typical, you have $100,000 that's being reinvested. And so we point out the quote unquote good news to them every year of, hey, look, regardless of what you might be taking out of the proverbial paycheck, the portfolio itself was investing on your behalf a meaningful amount of money every year. In and of itself, again, helping grow people's net worth. Those shares in turn produce more income. With more shares, there's more potential for capital appreciation. So again, back in its own way to point number one, by having this reinvestment vehicle, it becomes over time a total return vehicle as well. Point number three that we alluded to up above on a diversified portfolio versus just stocks alone shows you that over the last 23 years, a diversified portfolio has had similar return set, but with 37% less volatility. And from a max drawdown perspective, kind of peak to trough, 18% less loss than just a stock portfolio alone. So again, helping reduce that volatility, whether it's the dividend payers to non-payers up above, which was approximately 28% less volatility, or for an even more diversified portfolio compared to the S&P 500, 37% less volatility. That smoother ride that most people are looking for is aided by having income be a meaningful part of one's portfolio. The fourth and final reason is it's there when you need it. A lot of times when people aren't focused on income, they're either A, in a phase of life, or we're in the midst of a really strong bull market. But lives and markets can turn in a blink of an eye. And it's nice to have that income stream established and dependable, stable stream built before you need it. And so waiting to get insurance once the house is on fire, as the analogy goes, so too with the diversified or an income producing portfolio. Having that cash flow that's there that you know, even if you don't need it today, if a need arises down the road, is going to be there for you. So to recap, why income? One, it's a big part of return and doesn't keep you, but rather enhances returns over time. Two, it's a great savings reinvestment vehicle for you while you're not using it. Third, it helps reduce volatility, whether you're looking just at dividend payers specifically or more broadly speaking, diversification as a whole. And four, it's there when you need it. We hope that's helped. As always, we appreciate the questions that you share with us over time. If you've got any others you'd like us to address, we'd love to do so. Thanks so much.